Hello everybody. Today I'm just going to be going over real quick how to do the first DCF practice problem. I thought I'd make this video since I was a little confused myself on these problems, and so I think it'll be helpful to just explain the process I went through step by step. So first we're going to start by taking down all of the information needed. So we're going to start by reading out the problem. So Carlson Machine Shop is considering a 4-year project to improve its production efficiency. 4 years. So we're going to have years, and we're going to have 4 of them. All right, so the project will span 4 years. They're going to do this by purchasing a new machine for $480,000. All right, so that's going to be the purchase price. All right. And then it's going to result in savings of $160,000 per year. And then the press will be depreciated using 5-year straight line method. So it's going to be 5 years. And then I always do SL to abbreviate straight line. And actually I go like this. I don't know if that's the best way to do it, but that's how I like it, to just keep it nice and easy. So, and they expect to sell it for $60,000 at the end of 4 years. So we're going to say sale price. We're going to have 70,000. Sorry, I said 60,000 earlier. I meant 70,000 at the end of 4 years. The new press will require an additional inventory of 20,000. So additional inventory of 20,000, right? And maintenance will cost an additional it'll increase by 3,000 per year. We're not going to write that down right now, but we'll keep it in mind. Actually, we will. Per year increase, we'll do 3,000. And we'll talk about that later. But cost of capital. We have 14%, but we're gonna just make that 0.14, and tax rate will be 0.35. All right, perfect. Now we are asking, should Carlson purchase this machine? Now, to get started on this, we're going to kind of outline the income statement, or technically it's not really an income statement, but we're gonna use it like this anyway. So we're gonna do we're gonna go in years 1 through 4, or 0 through 4. So technically there is a year 0 in this calculation, and we only go up to year 4, despite the fact that we have 5-year depreciation. At least for this one, it's not going to matter. So we're just going to have years 0 through 4. Now, that takes care of our years computation. And now we're going to compute our gross profit. So we're going to have our increase, or we're going to do first our savings. Now, we're going to treat our savings like revenue, because what they do is essentially they're going to make our they're going to generate us more money. So we're just going to add the 1,600 all the way across. I could have done that easier, but we're just going to do that for now. So we're going to save $1,600 per year, or $160,000 per year, right? So that's our savings. Then we are going to have depreciation, and we'll just copy this over real quick. So depreciation. And what we're going to do with depreciation is we're going to calculate it down here on the bottom. So we'll just copy it again, depreciation. So 2, 3, 4, 5, 4. All right, depreciation, and then we're going to have book of value right here. So in year 0, our book value is going to be equal to our actual purchase price. Then our depreciation at the end of year 1 is going to equal our book value divided by the 5 years. So we're going to get rid of this now and just do 5. All right, so depreciation is going to be $96,000 a year. Now, what we're going to do here is we're going to hit Control F, or we're going to hit F4 on both of these, just F4, and that's going to add these signs, which really help you. And essentially that just stores it as relational, and it's going to always reference these two cells instead of moving when you pull over to a different cell. So I definitely recommend you doing that. So then our book value is going to equal our previous year's book value minus the depreciation of the past year. And now we're not going to F4 these because we want it to change over time. So we're going to be ending off with a book value in year 4 of $96,000. So we're going to copy and paste our depreciation values up here, and then we're going to get our adjusted earnings before income tax. Now technically these aren't earnings because, I mean, savings don't really increase earnings, but this is how we do it for most of the time, so we're just going to stick with it. So what we're going to do is we're going to just take savings, and then we're going to subtract out depreciation, and that's just going to give us our earnings before income tax. Then we are going to simply take that, and we're going to find how much we owe in taxes, because this is going to be our real cash flow. So equals this times this, and then this one we want to keep the same, so we're going to F4 it because we want it to use the same thing. So what we're going to owe is we're going to owe $22,400 more in taxes every year due to this purchase, and we're going to save $6,400. So our after taxes income, or we're going to say net income, which isn't really the proper word to say, but we're just going to do it anyway. We're going to do that equals those. So boom. So our net income is going to be $41,600 in net income that we are going to gain. So now technically we have to, hold on. Sorry, we're going to add back depreciation now. So we're going to do, so before we do that, we're just going to take depreciation and we're going to do that. And then we're going to do our net income, or our cash flows from operations. Okay. Cash flows from operations. I'm sure I spelled something wrong, but so all we're going to do here is we're going to do this plus this minus that. So what we're doing is we are adding our earnings before income tax to our depreciation, because remember, depreciation isn't actually a cash flow, so we're just adding that back in, and then we're going to take and we're going to subtract out our taxes. And so we're going to just copy that all the way across, and essentially we're going to have an increased cash flow from operations of $137,000 and $600 also. So that's our cash flow from operations. But that's not all we have. So we also have some additional, some change in net working capital. So we're going to go in and we're going to do that now. So our net working capital needs, we're going to put here, and then we're going to put our change in net working capital and the effect on cash flows. So net working capital needs. Well, in the first year, we're going to have a net working capital need of, in the 0th year, we're going to need an additional net working capital of $20,000. And then we're going to have to increase that by $3,000 per year. And that's going to go all the way up until year 4. We're going to leave that blank because it doesn't make sense that we're going to add $3,000 in the last year. And we'll talk about that in just a second. So for here, we're going to do this plus this to calculate our new one. We're going to go all the way across. And so essentially that's just the change that's being made in net working capital. And we're also going to, for this one, we're going to just do it equals that because it's a change from 0. We could technically create a formula to do it, but I find it easier like this. And then our net working capital needs in the last one is going to be $0. So it's just going to be equals this minus that. Now, it's pretty obvious that you just have this. And actually, it should be equals 0 minus this one instead. So because we need 0 and we had 29,000, so it's going to be a change in net working capital of negative 29,000. So how will this affect our cash flows? Well, cash flows have the inverse effect that the change in net working capital has. So we're just going to do equals negative the cell above, and we're going to get our effect on cash flows due to change in net working capital. And we're going to just go through all of these and hit F4, or we're going to go Control C, and we're just going to paste values only. I think there's a shortcut to do that. I just don't know it at the moment. So sorry about that. But so there's our change in net working capital. And then we also have the purchase / selling. So we're going to do a little bit more calculation here. So on the side, we are going to sell in year 4 our machine. So our book value of the machine, as you can see, is 96,000. So what we're going to do is we're going to sell equals, so the sale price. Then we're going to do minus equals the book value, right? And so then we're going to do this minus this gives, so the sale price minus the book value equals our profit. So our profit is negative, so technically it's a loss, but we'll just disregard that. So we lost 2,600. So now we have taxes, that we have to pay. So our taxes are going to equal 2,600 times our tax rate, or 26,000 times our tax rate. We get 9,100 from that. And then we're going to do our cash that we get. So, or our effect of, it's not our cash we get, but technically the effect on cash flow. So what we're going to do is we're going to do the 70,000 plus or minus the taxes that we paid on it. So we're going to get essentially the effect of making $79,100 in cash. So this is going to happen in year 4 is when we're going to get this 7,900, and then in year 1 we're going to have our purchase of the machine, and that's going to be negative. So now what we're going to do is we're just going to do our cash, our total cash flows, and what we're going to do is we're just going to sum essentially all of these, not this. We'll get rid of that. So we're going to sum those values together. We're going to copy it all the way across. Yeah, and that looks like it's right. Then we're going to have our net income, or net, we're just going to do Npv Net Present Value. And that formula is really simple. It's just the Npv. You're going to do your cost of capital, and you're going to do your final 4 values, and then you're just going to add in the value in year 1, and we get 42,300, and then you're going to get your internal rate of return. Now this one's even easier. You just select all of your values, and you get a 10%. We'll add a couple more zeros, a 10.2% to 1% internal rate of return. And if you go and check the answer key, this is correct. So I hopefully you guys enjoyed this quick little video. I don't know if it was helpful or not, but I just wanted to make the video myself because I thought it would maybe be helpful. And if you have any questions, please feel free to reach out if you want to. I'm more than happy to help, and I love teaching. It's something I love to do. So hopefully you all enjoyed, and I'll see you in class.